Now, the expected decision on interest rates continues to dominate business news today. A sizable hike is expected as inflation has spiked to a new record high at 7.4%. That's due to the continued rise in fuel and food prices. And that's exactly where our concern at this hour is going in terms of attention. We speak to Head of Commercial Strategy and Innovation at Experian Afrika, Jaco van Jaarsveldt. Thank you so much for your time, Jaco.
Thanks for having me, Tumi.
Now, we are seeing for the first time in this report the consumer credit default increasing. Let's talk about how burdened consumers are at this time.
Yes, I think to start with, what the consumer default index from Experian measures is the rate of first payment default for specific segments of the population or across the entire population. So it's a very quick indicator in terms of the stress at a consumer level, specifically looking at consumers that defaulted for the first time ever across their different products. So when we look at the numbers that we've seen in the last quarter, there's two different stories. On a year-on-year basis, there's an improvement, but on a quarter-on-quarter basis, which is a more immediate indicator of what the consumer distress looks like in the market, we've seen a deterioration. In fact, it's deteriorated over the last 2 quarters, which is a clear indication that consumers are starting to feel the distress of the numbers and the measures that you just mentioned earlier in terms of interest rate increases and inflationary pressure. Very different across different segments, but across all the segments, there's certain distress that we're seeing from the last quarterly numbers.
And we are seeing that defaulting is happening even with regards to unsecured loans. What element does that bring into the overall picture of the indebted consumer?
Yes, I think the most important measure here that we need to look at, to me, is the rate of default across the different products, right? So if you look at the impact that COVID had on consumers or on lending and the subsequent impact on consumers post the complete lockdown when the COVID pandemic started in March a few years ago, the immediate response from lenders at the time was they tightened lending criteria, number one, but also the lack of trade, specifically in the retail industry, resulted in far less credit being issued. So on a year-on-year basis, when you look at the consumer default index since COVID up until the last 3 quarters, there's actually been a significant improvement in consumer behavior or from a consumer credit perspective, simply because consumers had more disposable money because there wasn't ability to spend the money in the first place because of the lockdowns, and secondly because of the impact of COVID, the credit lenders, specifically in the unsecured space, started lending significantly less. So they tightened their risk criteria. And as a consequence, we've seen an improvement in the unsecured space. Even though there's a deterioration in the last few quarters, it's off a significantly lower base because of those 2 factors. Where the true distress is actually being seen right now is in the secured lending space, and that's the segment of the population that's exposed to home loans and vehicles. Right. And that's the top end of the market, actually. So very different to what we saw in 2008 during the financial crisis. It's actually the top end of the market that's under most distress now, and they are exposed to interest rates. And the higher interest rates and this interest rate pressure is causing distress along with the inflationary pressure and the cost of living increases. Whilst the population that's not exposed to that, more exposed to unsecured credit, they are also feeling the pinch. But because they are actually coming off significantly lower levels, the credit exposure has been reduced. However, what is unfortunate now is even the benefits that we saw with a lower credit exposure and a firmer financial position with a lower percentage of people defaulting for a first time in the unsecured space, we're seeing that trend change now because of the inflationary pressure.
Given that narrative, what's the outlook then? Because we are expected to see interest rates continue going up alongside inflation that is seemingly not abating even at a global level, and food and fuel inflation becomes even more of the concern.
Yes. And I think when you look at the inflation numbers at 13-year highs and the issue with it being supply-side inflation as opposed to demand inflation, the question becomes, how effective is monetary policy from an interest rate increase going to really be, and the impact it's going to have on consumers across all walks of life? So we do know from the inflation numbers that the individuals that doesn't have, or the population that's got less exposure to secured lending will have significant impact due to the inflationary and cost of life pressures. There was a comment made yesterday by a gentleman from from Stats SA that mentioned that roughly 50% of the bottom end of the market's income is spent on food. So there's a clear distress there. And we expect those people that in that segment have a big exposure to unsecured lending, and therefore we see the consumer default index in the unsecured space at the bottom end of the market deteriorating in months to come. Similarly, however, the interest rate increase in conjunction with the inflationary pressure will have a further impact on the top end of the market, whereas when I mention top end of the market, it's a more affluent market that have access to unsecured lending, or to secured lending products. And we've already seen that distress come through, and that distress is just going to get worse. So we don't see, from a consumer default index, improvement over the next few quarters simply because of the dual impact of inflation and then the interest rate spikes.
We'll leave it on that note as we all keep our eyes on activity ahead of the decision from the MPC, and that's the Reserve Bank's Monetary Policy Committee meeting. Those outcomes expected at 3 p.m. and it is widely expected that that body is going to once again decide to hike rates by at least 50 basis points. Some analysts are pegging for even bigger in terms of a hike there, but many of those decision-making updates are going to be dictated by the high uninflation in South Africa that has reached a new record high at 7.4%.